Silver has been ripping to new highs, and the move has been violent, with silver rising as much as 150%, surpassing gold's 65%. So, straight to the point. In this video, I'm going to explain why silver surged so hard, why this rally is not just hype, and what could realistically happen next. The story comes down to three forces hitting at the same time: industrial demand, supply constraints, and investor psychology. We will start with the biggest shift. Silver is no longer only a precious metal trade, it's also an industrial bottleneck. Industrial demand for silver hit a record 680.5 million ounces in 2024, and that matters because industrial demand tends to be sticky. And it doesn't disappear just because sentiment changes for a week. The largest structural driver is electrification. Silver is one of the best electrical conductors, and it shows up in power electronics, connectors, and high-reliability electrical systems. When you scale EVs, charging networks, and grid upgrades, the silver used per unit might be small, but the total volume becomes huge. Solar is even more direct. In 2024, solar alone used about 243.7 million ounces of silver. When solar deployment rises, it pulls silver demand with it, because silver paste is still a core input for many panel designs. Then there's the broader tech wave. Silver is embedded across high-end electronics and electrical infrastructure, and growth areas like AI data centers increase demand for power delivery, advanced components, and high-reliability contacts. You will always need silver in the production of electronic components, particularly in high-performance computer parts like the GPUs. Even crypto mining contributes indirectly because it expands the footprint of hardware and power systems that rely on the same electrical supply chain. Silver's superior thermal and electrical conductivity makes it irreplaceable for dissipating the immense heat generated by mining rigs. Now, the second force, supply, is not responding the way people assume it should. In 2025, global mined silver supply is expected to remain basically flat at around 813 million ounces. That's the key point. Even with higher prices, supply doesn't instantly ramp. A big reason is geology and timelines. Ore grades decline over time, and new projects take years to permit, finance, build, and ramp. Silver is not like an app. You can't scale it with a software update. But the deeper reason is structural. Most silver is not mined as primary silver, it's mined as a byproduct of other metals, especially lead and zinc. The Silver Institute estimates primary silver supply is only about 227 million ounces, roughly 28% of global output, meaning the majority of supply depends on what's happening in other mining sectors. That makes silver supply unusually inelastic. If base metal mining slows or gets hit by disruptions, silver supply can tighten even if silver prices are screaming higher. That's why the deficit story keeps coming back. The silver market recorded a deficit of about 148.9 million ounces in 2024, and the market has been running structural deficits for multiple years in a row. Over time, persistent deficits mean above-ground inventories get drawn down, and that makes price moves sharper when demand spikes. Now add policy risk, because policy doesn't need to ban supply to tighten a market. Sometimes all it takes is friction. China recently introduced a tighter export licensing framework for silver, naming a limited list of companies allowed to export silver for the 2026-2027 period. That doesn't automatically create a shortage, but it adds a layer of control that can tighten supply during stress periods. And on the producing side, disruptions are real. Big silver mining countries like Peru have faced serious security issues and periodic suspensions, which reminds you how fragile supply can be. Mexico, another major producing country, has been dealing with regulatory and permitting complexity that can slow new project development and expand timelines. So the fundamental setup looks like this. Industrial demand is strong and rising in key segments, while supply is slow and structurally constrained. Now the third force, investor behavior and market psychology, and this is where silver becomes silver. Silver often tracks gold, but with more volatility. When gold rallies on safe haven demand, falling real rates, or a weaker dollar, silver tends to amplify the move. In the recent spike, gold also hit record highs, and silver rode that wave. But silver did what it always does when it wakes up. It moved faster than most people were positioned for. There's also the debasement trade. When investors worry about inflation persistence, fiscal stress, or currency purchasing power, they move toward hard assets. Gold is the classic reserve asset, and silver becomes the high beta version of the same narrative. Another factor is the uncertainty across the globe. Russia, Ukraine, Venezuela, now Iran, all continue to underpin safe haven demand in commodity markets. And here's the accurate framing on central banks. Central banks primarily buy gold, not silver. But heavy central bank gold demand can still pull silver higher indirectly because it lifts the entire precious metals complex and attracts investors looking for cheaper exposure with more upside volatility. So what happens next? In the short term, expect volatility. Silver is famous for sharp rallies followed by sharp pullbacks. When price goes vertical, profit-taking and leverage unwind can create fast corrections that feel like the trend is broken even when the bigger story is still intact. In the medium term, there are two big scenarios. If industrial demand remains strong, especially solar and electrification, and mine supply stays flat near that 813 million ounce range, the physical market stays tight. In that environment, silver can remain elevated and can push higher again, especially if macro conditions stay supportive. But the bear case is real too. If global growth slows hard, industrial demand can cool. If real yields rise and the dollar strengthens, the precious metals bid can fade quickly. And if silver stays too high for too long, manufacturers will accelerate thrifting and substitution where they can, which reduces demand growth at the margin. Let's take a look at the latest silver price predictions from the major banks. The overall sentiment is pretty bullish, but there is definitely a wide range of opinions on just how high it can go. Goldman Sachs leads the bulls, viewing silver as vital for the green transition and forecasting $85 to $100 an ounce for 2026. Citigroup is also bullish, generally eyeing $60, $72 this year, but suggesting it could skyrocket past $110 in late 2026 if supply tightens. Bank of America added to the momentum by raising its 12-month target to $65. Conversely, HSBC takes a cautious stance, projecting an average of $68 in 2026, then dipping to $57 in 2027 due to potential demand easing. My base view is that silver's long-term direction can stay positive when deficits persist, but the path will be messy. Think higher highs with violent pullbacks, because silver is both an industrial metal and a macro trade. It is a long-term investment, not for quick money. If you want a simple checklist, watch 4 things: the trend in gold, the dollar and real rates, evidence that solar and electrification demand are still expanding, and whether supply remains flat while policy friction stays high. Silver isn't just a precious metal right now. It's a precious metal plus an industrial bottleneck plus a macro trade. That combination is why it can surge so aggressively, and why the next phase will likely be dramatic too. Thanks for watching. I am Professor Portfolio. Please drop a like and subscribe if you find this video helpful.